Hey, good morning and welcome to Core Services and our Core Belief Series, Why It Matters. Today we're going to be discussing a second case study on internal control failure, and this one is around the recording of a special assessment that went horribly wrong. I'm John Coggle and I'm today's presenter. So a little bit about Core Services before we begin. We're focused on audits and review services for condominiums and HOAs. We have over 40 years of combined experience working with these types of engagements, and we also offer board advisory services where we can help the board become more effective at oversight of their associations. So, obviously one of the big things is when we find something wrong, and it almost always has to deal with some sort of internal control system that went sideways. A policy wasn't followed, a procedure wasn't done, or there was no independent oversight of a transaction. In this particular case, board passed a special assessment. There were 125 units in this condominium project. It was worth $2.5 million. At the end of the day, there were 10 orders paid in full, and so they were carrying a balance of about $2.3 million supposedly. When we looked at the reports and we looked at the trial balance, they treated it as an ordinary assessment. For the rules, for those who are curious about the rule for a special assessment is it essentially becomes revenue when it's assessed, and is essentially earned as the special project, the repair project, is completed. So by treating it as an ordinary assessment, obviously they ended up with $2.5 million of expenditures for their remodeling for the reserve project and no income because of the way they treated it. Not a good thing. So obviously, because of the way it was set up, there should have been interest for all the owners who were financing it. There was no interest income on the books, and they had a prepaid assessment of about $190,000 sitting as a liability, and no special assessment receivable. Okay, so when we look at this and we're looking at this thing and we're going, this doesn't work. Why? Well, because the financial statements had been consistently presented as prepared under generally accepted accounting principles, which obviously means, like we said, special assessments income when we do the work. There should be interest income on the outstanding balances. There was none recorded. And obviously that receivable needs to have been on the balance sheet. So as we dug into it, obviously what we discovered when we talked to management is they prefer doing this on the cash basis and treating it as a normal, what they called a serial assessment, which would have been a 10-year commitment on a monthly basis for payment, which is true, but is not generally accepted. They didn't want to have to constantly go in and update what's known as the amortization schedule for every time an owner made a payment. And if they skipped a payment, they would have had to accrue interest. And that really, when it came down to it, when we approached them with it, their excuse was, well, other auditors let us get away with this. Okay, that might be true, but it doesn't matter. GAAP is GAAP. You say you're going to present financial statements in accordance with GAAP, you have to follow the accounting rules. The other problem we ran into is when we reviewed the resale certificates for units that were sold, obviously the selling owners were given inaccurate information on how much they owed, which meant that when it closed through title, the association did not receive the money for the outstanding lien on that property, but title changed. And so there was a very large likelihood that the lien was going to be unenforceable because title was never told that the loan was outstanding. And because the loan wasn't outstanding, it wasn't listed as an assumable loan by the new owner, which meant the new owners can basically say, I wasn't made aware, which means that if they still didn't make the payment on it, it was probably not going to be enforceable. Obviously, we don't practice law, but we did discuss with an attorney who felt that was a potential glaring problem. So why does it matter? Well, again, the material weakness is they didn't apply GAAP correctly. They didn't apply GAAP at all. And they felt like it was not their place to keep the books in accordance with GAAP, even though the financial statements were required to be GAAP under Washington state law. Because they weren't tracking the owner payments, it caused the other errors with the resale certificates, which could be considered a violation of state law, not to mention a breach of fiduciary responsibility, not to mention the fact that it probably would have cost additional resources down the road if the association tried to sue for foreclosure, and potentially might have lost, and so they wouldn't have been able to collect that money, which meant the other owners would have had to pay the balance. And when we asked the questions, who reviewed these things, there was basically no one. The community manager presented the information to the accountant, the bookkeeping staff, and the bookkeeping staff recorded it, and no one questioned whether it was right. So we discussed it with the board, gave them our recommendations, one of which was honestly to disclaim an opinion, not withdraw, but disclaim an opinion. They didn't feel like that was appropriate. They preferred to make sure that we got the numbers correct. So they authorized us to do additional procedures to try to come up with the appropriate balances, which means they paid us a lot more money. It almost equal the amount that we charged for the audit to go back into 125 units and redo the amortization schedules, which meant that obviously by the time we were done, every month's reports that were issued were incorrect, and those needed to be restated, which, you know, again, that's a managerial and board issue, but they were completely wrong. And really what it did was it actually diminished the board's confidence in management's abilities to solve these problems. So why does it matter? Well, it's important to remember board set policy. In this case, their policy was financial statements needed to be presented in accordance with generally accepted accounting principles. Assessments, and especially special assessments, have rules that are called out in GAAP and in the ASCs, the Accounting Standards Codifications. And the board also has a responsibility of oversight of management. And yes, the board, someone on the board probably should have asked why the special assessment didn't look right, but their excuse was they're not accountants and they relied upon management. Management's excuse was the board told them what to do and they approved the financial statements. That's that same particular thorny issue where management says, well, because the board doesn't question it, it must be right. And management needs to make sure they implement the board's policy correctly. In this case, they should have created the amortization schedules for all those. Someone in that organization should have questioned the accounting treatment for special assessments. If you're not certain of what GAAP requires, it doesn't hurt to send an email. Your auditor enjoys the interaction, believe it or not. They'll probably answer this question and there won't be a fee. And if you don't want to talk to the association's auditor, talk to your firm's accountant. Again, if they don't understand it, they can get the research done to help you make sure you record these things correctly. And really, our position was the management company should have paid the additional fees to get the accounting right, because they'd already been paid to do the accounting and they did it wrong. But the board wasn't going to push it. It's not our place to tell the board how and why to spend money. But our honest opinion is, when boards make mistakes, or when management companies make mistakes, management companies should pay for it. So, especially when it comes to something like a special assessment, take a deep breath and ask yourself, does this make sense? And if you're looking at this, you simply want to know the cash flow impact, there's better ways to report it, and you might have to pay a little bit more as a board to get accurate accounting treatment for a special assessment, but it would probably be worth it because you're going to end up paying for it in the long run anyhow. So, hope you've enjoyed today's presentation on another additional breakdown in internal controls. If you have any questions, feel free to go to our website or contact us either on Twitter or LinkedIn. Hope you have a great weekend. Look forward to talking to you soon.